Okay, let's unpack this. Have you ever stopped to truly think about what money really is? I mean, it's so central to our daily lives, right? Yet its true nature, how it works, where it came from, it often remains, well, a surprising mystery. Today, we're taking a deep dive into your sources, a really fascinating stack of articles, historical accounts, and cutting edge insights.
Mhm.
We want to explore the surprising journey of money, from ancient bartering all the way to the pixels on your screen. Our mission, basically to give you a shortcut to being well informed about this thing that drives our world, with plenty of aha moments, hopefully.
Absolutely. And what's truly fascinating here is how much of what we think we know about money is based on, well, long held assumptions or even myths. We'll trace its evolution, look at the surprising truth of how it's created today, and uncover some critical insights for protecting your own financial well being. Because we're in a world just awash with information and sometimes, let's be honest, misinformation, which raises a really important question right from the start. If money isn't just paper or metal, then what truly gives it value?
That's the perfect question to kick us off. When we talk about what money is, beyond just the physical stuff, we have to look back at how it started. Before money, there was barter, right? But the sources really highlight just how cumbersome that system was.
Oh, incredibly so.
Imagine you're an orchard owner, loads of apples, but you need boots. You don't just need a cobbler.
You need a cobbler who specifically wants apples right then. That's the double coincidence of wants problem. It's a huge barrier to efficient trade.
Exactly. And without a common standard of value, how could you even account for things as societies got bigger?
It was almost impossible. There's a classic anecdote in the sources that perfectly illustrates this logistical nightmare. Mademoiselle Zélie, a French opera singer,
Ah, yes, I saw that one.
after a concert in the Society Islands, her share of the proceeds came in, get this, 3 pigs, 23 turkeys, and 44 chickens.
Try doing your taxes on that.
Chuckle slightly. Exactly. No thanks.
So this inherent inefficiency, it naturally pushed societies towards something more standardized. And that brings us to the two main theories about what money actually is: the commodity theory and the credit theory.
Right. The commodity theory suggests money is a physical good with intrinsic utility, meaning it has value beyond just being currency. Think about early forms: cowries, cattle, grain, later precious metals. These things had inherent value or a direct use.
And the sources give some really wild examples that challenge our modern ideas of value, like the Yapstone discs, the Fay,
Oh, the yapstones, amazing. Some were enormous, right? Up to 20 feet across.
and many stayed at the bottom of the harbor after sinking during transport, yet they still counted.
They did. They were badges of rank, had religious significance. It's fascinating how Captain O'Keefe, an American-Irish sea captain shipwrecked there, even directed the quarrying of these stones later on.
20 feet.
Yeah.
That makes you wonder, why would anyone accept such an impractical currency? What does that tell us about money's value?
Well, what's really powerful about the Yapstone story, I think, is that it perfectly shows money's value isn't always about physical utility. Not at all. It's about shared belief, social consensus. Even if a massive stone is at the bottom of the ocean, if everyone agrees it represents wealth and its ownership is recognized, it is money.
That's profound, especially when we think about digital currencies today, which are purely abstract entries.
Exactly. It puts it into perspective.
Another intriguing example from the sources was wampum. These beads became legal tender in American colonies, like Massachusetts in 1637. But their value famously tanked along with the beaver fur trade.
Yeah, the wampum story isn't just a historical curiosity. It's a stark reminder that even commodity money is ultimately a social construct. Its value was tied to something as specific as beaver fur. It shows how easily perceived scarcity and demand, not just intrinsic utility, can dictate a currency's fate. It's a timeless lesson, really. Even seemingly solid forms of money are subject to market forces and, well, shifting perceptions.
That makes total sense. So whether it's a giant stone or a tiny bead, it boils down to a shared understanding of its worth. And that leads right into the credit theory, doesn't it? The idea that money is a social construct, an abstract promise of value, basically a credit relationship.
Exactly. The key here is that the promise needs to be credible. The issuer has to be trustworthy, and it must be transferable so others will accept it as payment. It's about trust, fundamentally.
Right, trust. And eventually we get to something more familiar: coinage. The sources say coinage emerged around 600 BC, but I found something really surprising in the sources about how banking developed relative to coinage. We often think of coins as ancient, but what did the sources suggest about which practice actually came first, and by how much?
You picked up on that. It's counterintuitive, isn't it? The logical development isn't what you'd expect. Sophisticated banking practices, like those of the grandsons of AGB in Babylon offering current accounts, even checks actually predated coinage by 1,000 years.
1,000 years. That's incredible.
Yet, in Britain, banking followed coinage by a similar period. It really shows how different societies evolved their financial systems at different paces and how sophisticated some ancient practices really were.
And speaking of ancient finance, the sources mention Hycesius, the philosopher Diogenes' father. He was banished for adulterating silver coinage.
That's right. It highlights that the struggle against counterfeiting is basically as old as money itself, always trying to cheat the system.
It's also amazing where the words money and mint come from.
Oh, the goddess Mona story.
Yeah, both from the Roman goddess Moneta. Legend has it, the geese at her temple on the Capitol warned Rome of a Gallic attack back in 390 BC, saving the city.
So in gratitude, the Romans built a shrine to Moneta, the goddess of warning or advice, and that's where they minted their first coins.
Incredible story. History, myth, finance, all woven together.
Okay.
Moving into medieval times, we see early Celtic coinage and then the huge impact of the Vikings on English money.
It's really telling, isn't it, that more English coins from that era have been found in Scandinavia than in England itself. Shows the scale of their raids and influence.
Definitely. Then after the Norman conquest, William I tried to standardize things using the Doomsday Book to figure out who had what.
And to ensure currency purity, they had methods like the simple touchstone for rough checks, but also the incredibly meticulous trial of the picks.
Formed by the Goldsmiths Company, established way back in 1248 and still going today.
Amazing continuity.
Perhaps one of the most fascinating medieval financial tools, though, was the tally system.
Ah, the notched sticks.
Exactly. An ancient form of payment evidence, the exchequer used them as receipts. Samuel Pepys, the diarist, even complained about delays in getting his tallies. But what started as simple receipts evolved into negotiable interest-bearing money. So much so that, as one source put it, English medieval finance was built upon the tally. Sticks as money. Astonishing.
It truly shows how human ingenuity adapts, doesn't it? Creating trusted systems of value from, well, anything. And globally, the Crusades, despite their immense cost and distance, spurred the development of early semi-banking functions. Intermediaries like the Knights Templar started offering services to transfer huge sums of cash safely across long distances, facilitating commerce, military ventures.
It's a powerful reminder of how conflict can sometimes drive financial innovation, strangely enough.
Yeah, necessity is the mother of invention, even in finance.
So we've traced money's ancient roots, seen how humans kept seeking more efficient ways to trade value, but the real game changer, the shift in its very form, came when money left the realm of tangible things and moved onto paper. And then, incredibly, to pixels. That's where its journey truly accelerates.
Indeed. And the journey of paper money is full of cautionary tales. China, for example, adopted paper currency way back in the 9th century. But by the mid-15th century, the Ming note, nominally worth 1,000 cash, was actually worth only 3. It shows the perils of overissuance, how quickly trust can just evaporate.
A similar story played out in 18th century France with John Law's system, right? His Banque Générale initially saw its banknotes appreciate.
They did, for a while. But the system ultimately collapsed due to massive overissuance and rampant speculation in his Mississippi company. A vivid lesson on the dangers of an elastic money supply without proper controls.
And in America, early monetary development was just as, well, turbulent. The Revolutionary War was financed mainly by printing vast amounts of paper money.
Leading to what they called continental debauchery, hyperinflation essentially.
Then the young nation struggled to set up a stable national banking system. There were fears of foreign influence. British shareholders held big stakes in the Bank of the United States and huge constitutional debates over federal power.
These struggles really highlight that constant tension, needing a stable currency but also an elastic one. A money supply that can expand when the economy needs credit and contract when it's overheating instead of being rigidly tied to gold.
And this lack of flexibility, or perceived lack, became a flashpoint during those devastating bank panics in the U.S. 1873, 1893, 1907.
Absolutely. Those crises ultimately showed the urgent need for a more robust system, which led directly to the creation of the Federal Reserve System in 1914.
And the most profound shift for modern money probably came in 1971.
Ah, Nixon closing the gold window.
Exactly. The U.S. dollar's convertibility to gold ended. This really marked the global ascendancy of fiat money currency, backed not by a physical commodity, but by government decree and, crucially, public trust.
Which brings us to today. So if it's not gold, and it's not even a direct promise to convert to gold, how is money actually created now? This is where that common misconception, the money multiplier theory taught in many textbooks, needs, well, updating.
Right, the idea that banks just multiply central bank reserve. The reality is more dynamic, isn't it? So how do banks actually create money?
Well, the reality, as outlined in sources like the Bank of England papers, is that money is primarily created when commercial banks make loans. Think about it. When a bank grants you a mortgage, it doesn't usually lend out existing savings. It simply credits your account with new deposits.
Poof, new money.
Essentially, yes. It's creating new money. The central bank's role isn't so much to directly control the quantity of reserves banks hold, but rather to influence the price of those reserves. That is, interest rates.
That's the concept I think many people find counterintuitive. So what stops banks from just creating endless amounts of money if it's not a fixed pot of reserves?
Good question. The ultimate constraint isn't really a fixed quantity of reserves. It's the central bank's monetary policy, aiming for price stability, like the Bank of England's 2% inflation target. Plus, banks themselves are constrained by considerations of credit risk. They won't lend endlessly if they don't think they'll be repaid. And capital requirements, regulatory things too.
Okay. And this idea of money being created simply by banks extending credit rather than from a physical source, it really sets the stage for the next frontier. Digital money, where the lines between what's real and what's digital get even blurrier. We've seen the evolution from early electronic purses like Mondex and Swindon back in '94.
I remember Mondex. A bit ahead of its time, maybe.
Yeah, perhaps. To modern mobile wallets, Venmo, Google Wallet, Apple Pay. These have totally changed how we interact with money daily.
But how do these digital transactions stay secure? How do you prevent the double spend problem, spending the same digital money twice?
That's where blockchain comes in, right?
Exactly. It's essentially a distributed, secure ledger. Altering one transaction would mean hacking that block, plus all the preceding blocks in the chain, across millions of computers simultaneously. It's theoretically much more secure than many traditional centralized systems because of that decentralized nature. Vitalik Buterin, a Canadian, developed Ethereum, one of the most prominent blockchains.
And looking ahead, central banks themselves are exploring CBDCs, central bank digital currencies. What's the main driver behind that?
Often it's about reducing the costs of handling physical cash and increasing payment efficiency. Project Jasper in Canada explored using something like CAD coins on a blockchain for interbank settlements. And China's People's Bank of China is actively exploring its own digital legal tender for general public use. It's a huge step towards potentially reshaping currency itself, blending the stability supposedly of central bank control with digital innovation.
It's incredible, from physical objects to abstract digital entries. But whether it's a yapstone or a pixel, money is still fundamentally a human invention, shaped by our choices, our biases, our trust. Which brings us to maybe the most crucial part, the human side of finance, how we navigate our relationship with money, manage risks, avoid pitfalls.
Absolutely. And this is where behavioral economics comes in. Unlike traditional theory, it acknowledges that people don't always make perfectly rational financial decisions, even with all the info. The foundational work by Amos Tversky and Daniel Kahneman introduced concepts like the availability heuristic.
Where we over-rely on easily recalled information.
Exactly. Rather than actual data when assessing risks. Like you hear a vivid news report about a shark attack, you might overestimate the danger, even though statistically it's incredibly rare. Our brains take shortcuts.
It's amazing how prone we are to those biases, even when we think we're being logical. And speaking of things affecting everyone, inflation, the silent eroder. What exactly is it, and what are its main forms?
Inflation is that general increase in prices, meaning your money buys less over time. The sources outline three main types. There's demand pull inflation, too much money chasing too few goods. Then cost push inflation, rising production costs like higher wages or raw materials. And built-in inflation, which is often that wage price spiral. Workers demand higher wages to cope with prices. Businesses raise prices to cover costs, and round it goes.
Sounds like a multi-headed beast. But personally, what's the single biggest way inflation quietly hits the average person, maybe without them fully realizing?
Well, the most significant impact is simply that it erodes the real value of your savings. The money you saved last year buys less this year, silently. It can also encourage spending now before prices rise further. And it affects international trade through currency values, maybe good for exporters, bad for importers. It's a really widespread experience. Your sources noted that over 90% of the world's current population has lived their entire lives in an age of, well, unprecedented inflation. Some places, hyperinflation is almost the norm.
Wow. So how do we navigate this personally? Let's get practical. Budgeting and debt. The sources mention common systems like the 50-30-20 rule.
Yeah, a good starting point. 50% of take-home pay for necessities, 30% for wants, 20% for savings and retirement. Simple, but effective for many.
And building an emergency fund is just crucial, isn't it? Aiming for 3 to 6 months of basic living expenses.
Absolutely vital. It might take time to build, but it's that buffer against unexpected shocks, job loss, medical bills. And when it comes to tackling debt, there are different strategies. The snowball method involves paying off the smallest debts first.
Gives you that psychological win, keeps you motivated.
Exactly. Then you roll that payment into the next smallest. While the avalanche method
Focuses on the highest interest rates first. Mathematically, it saves you more money in the long run, but maybe requires more discipline.
Precisely. Both work. It depends on what motivates you.
But even with solid planning, we need to be aware of scams. The sources detail some common ones, like that fake check over payments scam.
Oh yeah, that's a nasty one. Someone accidentally sends you too much money for, say, some modeling work they found on Instagram, or a prize you supposedly won.
And asks you to wire back the difference. But their original check will bounce later, leaving you out the money you sent.
Exactly. And there are debt collection scams too. Fraudsters pretending to collect debts you don't actually owe or have already paid.
The advice seems clear. Independently verify everything. If someone calls about a debt, ask for their name, company, street address, professional license number. Do your own homework.
And watch for red flags, refusing to provide written proof, using threats, understanding why these scams work, preying on urgency, greed. Sometimes fear is your best defense.
Right. Moving beyond personal finance, though, there are bigger complexities. Systemic risk in the financial world. Speculation, for instance.
Yes, buying or selling assets, hoping to profit from price movements. It can contribute to market efficiency, help price discovery, but it can also fuel bubbles and lead to large-scale failures. Keynes had that great quote: "When enterprise becomes the bubble on a whirlpool of speculation, the job is likely to be ill done."
That's a powerful image. And to try and curb excessive short-term speculation, some have proposed a Tobin tax, a small tax on foreign exchange transactions. What's the main idea there and why the debate?
The main idea is to put a little friction into the system, discouraging hyper-fast, high-volume speculative trading, hopefully stabilizing currency markets. Proceeds could potentially go to development aid or global public goods, but it's debated. Critics worry it might reduce market liquidity or just be bypassed through tax havens if not implemented globally.
Makes sense. Then there's systemic risk. The idea that failures in one part of the system can cascade and harm the whole thing, creating negative externalities, hurting innocent bystanders.
Precisely. And this leads to the whole too big to fail concept. What does that really mean for the average person?
Well, it stems from crises like the near collapse of Continental Illinois Bank back in the 80s. The idea is some institutions are so large and interconnected, their failure would crash the whole system. So authorities might feel forced to bail them out to prevent catastrophe. But that creates moral hazard. The institutions might take more risks, knowing they'll likely be rescued.
A real dilemma. And on the darker side, we have money laundering.
Right, the process of making illicit funds look legitimate. Typically 3 stages. Placement, getting the dirty money into the system.
Then layering, obscuring its origin through complex transactions. And finally, integration, reintroducing it into the legitimate economy, often via real estate or businesses.
And lastly, the sources touch on domestic justice and access to financial services. The argument that everyone should have a right to basic things like a bank account.
Yes, because lack of access forces poor individuals into a cash-only economy. That makes them vulnerable to predatory lenders, check cashing fees, and just makes it harder to save or build credit. It's a critical issue for social equity. Shows how fundamental access to the financial system is for just basic well-being.
So after all this,
Yeah.
what does it all mean? We've journeyed from pigs and pebbles to these abstract digital ledgers. We've seen how money's form and function constantly evolve, driven by human ingenuity, but also human flaws, right? It's clear money is way more than just a tool for buying stuff. It's a reflection of our societies, our trusts, our challenges.
Absolutely. And if we connect this to the bigger picture, you see this recurring quality versus quantity pendulum throughout monetary history. Debates like the 19th century currency school versus the banking school, they were arguing about this. Should money be rigidly tied to gold, quality, or flexible based on economic needs, quantity?
And that echoes in later debates, too.
Definitely. Think Keynesianism versus monetarism in the 20th century. One favoring active demand management, the other focusing on controlling the money supply itself. They're all grappling with that fundamental balance. How do we get stable, trustworthy money, but also enough credit to fuel growth? It's a constant tension. As Professor Goodhart wisely observed, any observed statistical regularity will tend to collapse once pressure is placed upon it for control purposes.
Right, Goodhart's law. And for anyone wondering, what that basically means is, as soon as policymakers try to use an observed economic pattern to control the economy.
People change their behavior in response.
Exactly. And the original pattern breaks down. It's like trying to steer by looking in the rearview mirror when the road ahead is curving because you started steering. It shows why managing monetary systems is so tricky. They're inherently human dynamic systems.
Precisely. Which highlights an important, often overlooked truth. The price of monetary and therefore arguably other liberties is eternal vigilance, constant adaptation, constant questioning.
So after this whole journey, what stands out to you about money's story and its impact on your life, on the world? Maybe it's the surprising origin of words like money, or the ingenuity of ancient Babylonians, or maybe the sheer weirdness of yapstones counting as wealth, or the complexities of digital currency today. Whatever it is, understanding money's secret life, its history, and how it actually works, it really arms you with valuable insights, not just for your own finances, but for making sense of this global economic landscape we all live in.